in the second half. Why? Because the US will be keeping these rates for some time. They say 8, 9 months, whatever. So maybe by end of year the US rates will be cut, which also allows India to cut and all that. And the world is actually relishing a rally. Then all that will happen by end of the year, because a few months will be at these high rates, which are not increasing anymore, but are still quite high, the US rates. And therefore, I think end of the year you might in one spurt get the last 5, 7, 8% overall returns higher than 10% for sure, I think.
So the gains will come in the last quarter?
I'm saying if for the general year the market is flat to up a little and then you get something right at the end, that also makes sense. All we don't like is a minus 10% kind of a year. Plus, we all accept that over time equity markets beat debt by a reasonable number, which is like 5 to 7% per annum, which is basically the equity risk premium, which means what the equity markets deliver relative to government 10-year type bond of that same market. That globally and in India on annualized basis is 5, 6, 7% per annum. So that normally leads us to be 13, 15, 14% type of return, which you can see we have done for the last 25 years, for the last 10 years, for the last 18 years. Why I say 18 years? Because Helios started 18 years ago, so I know exactly what the index has done. Broadly speaking, it does 13, 15%. So plus minus a little bit, it'll do the similar amount.
No, what you say is especially important this year because a lot of local investors have this quandary because last year was flat for equities. This year they're saying they'll get 7-8% on fixed deposits. So
yeah, that is true.
Equities have to beat that 2 years running. Will they be able to beat that?
Over time they will beat. If they don't beat it in 1 year, then they will beat it with compound interest in the next year. So you look at 2000, 2001, 2000.
And India in this light and what we have experienced in the last 5 years, and particularly with China now on the decline. China is, people sort of say China economy is finished and all, but that's all rubbish. China is the second largest economy in the world, about 6 times the size of India. So even if China grows at 3% and India grows at 6%, the overall input they have, the growth is much more than what happens in India. But nevertheless, China is on the decline, which is a big change for India, and we are getting that advantage. We have never seen that normally when such a large economy like China goes down, it has an impact on the world because demand goes down. There's such a big part of the buying and selling. But for India, I think it's an advantage because we are mainly buying from China. So we should get things at a slightly cheaper price. Our main imports are either consumer goods from China, consumer and industrial goods from China, and of course crude oil. So if China demand goes down, then crude oil also relatively it has an impact. And of course at the moment even Europe and all are under strain. So this sort of juxtaposition of India with the rest of the world is their problems are not really affecting us so adversely, I feel. But in fact, it is to our advantage. We can take advantage, and especially the low manufacturing industries. I'm in the luggage manufacturing, which is one of probably the smallest category of anything. But even there, China was the world's capital of manufacturing luggage, like so many other consumer goods. Unfortunately, it's a very labor-intensive industry, but all the once consumer imports were allowed. A lot of people don't remember that consumer imports were totally banned into India up to the year 2001. So we had to make everything what we sold in India. And so after that, after the imports were relaxed, and now in the initial period the duties were about 85%, but very soon, within 4 or 5 years, they came down to 10%, which I think was very anti-Indian. Though it benefited to drive that
whole ethics into the mind of the founder and or the founding team also.
Let's hope that wiser sense prevails, and we are again back to seeing startups doing well and new age companies in India doing well, and the funding coming back in good form. Thank you very much for this lovely session. Thank you.
Adequately skilled, and those gaps need to be filled mostly by the market, but those gaps are there, and that may create volatility in wage costs. So there are quite a few things to worry about. It's not going to be a straight line. It never is a straight line. There'll be fair number of ups and downs, but on a relative basis, I think this is as optimistic as you can get on India on a 30-year time scale.
Devina, what is the case for the story which had enormous promise but went wrong for India? I mean,
a demographic dividend, because see, the demographic dividend has three parts. There is what proportion of your population is in the working age, into what percentage of that is actually working, into the productivity. So we have the first bit, which is that a large working age population, but we have that for a limited period of time, just as every other country in history has had. But we have not been able to find employment, even pre-COVID, our unemployment rate was at a 40-year high. Unemployment is even higher among the young. So that is what worries me, that you will never get that demographic dividend actually show up in the economy, because you're not able to employ those people. And that employment drives things at both levels. One is at the output side, manufacturing or services, as well as then therefore that per salaried person consumes stuff and therefore drives demand for everything else. So that to me is that we'll miss that bus. That to me is the biggest worry. And which also ties into education, health, especially after the pandemic when children have lost 2 years of schooling. Because if you don't invest in education and health, you'll have a next lot of unemployable people. So for, whether for the budget or longer term policy, those have to be the focus areas: employment, education, health.
Sharp reduction in corporate taxes. Private investment isn't stepping up to the plate. And I think Nirmala Sitharaman has publicly spoken up about this a couple of times, nudging India in to do more when it comes to investment. But that, for some reason, doesn't seem to be happening.
So I don't think there is any other option but to be patient. We have to understand that even pre-pandemic, India was going through pretty slow growth compared to what India's history has been. And the pandemic has obviously had almost 2 years of low growth. And now with this whole geopolitical uncertainties, it's difficult for private capex to immediately pick up, given the background that we have seen of last 5-6 years. But what we have to also keep in mind is that we are now reaching almost all the preconditions that are required for a private capex to come. Look at corporate balance sheets, if you look at the financial system balance sheets, we haven't seen this kind of a balance sheet in almost a decade. So with the right kind of public capex and the policy thrust that is there towards manufacturing that this government has put forward, I think it's just a matter of time we will see a private capex recovery.
But Soumya Kanti Ghosh, this is something that the pundits have been saying for a long time. The capacity utilization is in the mid-70s. India is poised for a multi-year investment cycle, an investment cycle which so far hasn't kicked off in right earnest. Why? And do you think, like Samira, that that's now finally about to change?
Yeah, thank you, Rahul. No, I think that last 2 years during the pandemic, if you look into the corporate balance sheet, they have significantly deleveraged, and so that's the first thing. So that's one of the big conditions for investment taking off. The second point to note is that if you actually look into the bank credit today, credit growth actually has continued to expand, even though there has been some moderation in the recent weeks. And a large part of this credit growth is not only the working capital requirement, which typically comes when the inflation is on the higher side, but also term loans and also some project announcements, as we are seeing in our books. So in my sense, I think there is evidence of a pickup in private investment activity, may not be that encompassing which all of us want it to happen. But at this point of time, if I look into the sectors which is deliberate, like steel, like the metal sector, there is evidence of some amount of private investment picking up. But as we progress, and as basically as all of you also, as also there has been a lot of geopolitical conflict and uncertainty. So I think as the fog clears on the global economy also, I am sure that the investment is going to take off in a meaningful manner.
Second thing, and this is again something which has led to a lot more speculation, is investing in a lot of these. I wouldn't say fads, but something keeps happening every year. So you had the US investing, you had cryptocurrency, you had sector investing. What happens is a lot of investors tend to overvalue owning something which is extremely exotic because it's a lot more interesting. But actually, wealth creation happens in very simple products. I think an investor should ideally, have most of their portfolios in simple products, and obviously if they are looking at something complex or something which is exciting, that should be a relatively smaller part of their portfolio. And the same with international funds. I think what I've seen is investors who go chase after these, electric vehicle or biotechnology or these sort of thematic funds. It's very exciting to invest in these sort of themes, but actually, wealth is made if you invest in something as simple as an S&P 500 fund or like a simple broad-based mutual fund, and just sort of sticking to. I think consistency is very, very important for investors, and investing in general. I think remain invested. If you have a thesis of you wanting to put in 15 to 20% of your portfolio outside, stick to that thesis and make sure it's there for the portfolio.
Neil? If you want to add to that in terms of what you're looking at in 2023, in terms of overall strategy with regards to all the moving forces when it comes to global markets right now.
So let me try to answer this slightly differently. So a couple of years back or during COVID, somebody asked Jeff Bezos of Amazon that so much is changing. How are you looking at things and how are you looking at change? And he had something very interesting to say. He's like, I'm not really focused on what is going to change. I am more focused on what is not going to change. So let's see for Amazon. So he said that for Amazon, what is not going to change? Even 150 years, 100 years from now, what will not change? One is that when people are searching on Amazon, they are looking for the lowest cost product, So my job is to keep making the cost lower and lower. It's not like we go to Amazon and look for the highest, the most expensive product, So cost has to come down. Secondly, people want more and more choices. So his thing is that people are 50 years from now also going to want more and more choices. They're not going to want less choice, for the products they want. They want to compare and they want to contrast. So he's like, the second thing I need to do is have more and more choices. Third thing is that people want quick delivery. It's like when you order, it's like my thing is that how do I make logistics more efficient? How do I make the product go quicker to your place, It's not like when we order food or something, we want it immediately. We're hungry right now, whatever, 5 hours or something like that. So he's like, these 3 things I need to consider on: lower cost, more product, and faster delivery. So he's saying that's not going to change ever. So I'm more concerned about those things. When it comes to investing and what are we looking at, so what is not going to change in investing? Partnering with good managements is not going to change. If there's a chore management 100 years back, he's going to swindle you. Today there's a chore management, he's going to swindle you 100 years from now.